When you're investing in real estate, whether it be active, where you're pulling the trigger, you're finding the deals, you're running the deal, or whether it be passive, where you're simply investing in someone else's deal, it's really, really, really important that you know, understand, and believe in the strategy and the philosophy of the driving forces behind what is taking place, the areas and the types of properties that you're investing in. My team really likes C and B class properties in C and B type areas. So with these different types of properties, you've got A, B, C, and D type properties. Property types are loosely defined based on their vintage, when they were built, and the types of amenities that you may have on site, okay? So something that was built in the last 10, 15 years, tons of amenities, this is going to be an A-class property. The older that the property gets and the fewer amenities that it has, the further down that scale it's going to go. A, B, C, and D, okay? D is generally something that's totally run down, totally beaten up, and is really kind of functionally obsolete. We don't really buy A-class properties because generally those properties are really, really expensive. When you're paying a lot of money to acquire one of those properties, what it's doing is it's minimizing your upside on the back end, right? We also don't really like D-class properties because there's a lot of risk in those deals. You have a lot of upside, but high risk, high reward. And we don't think as a fiduciary for our investors that that's a good risk that we should be taking with our investors' capital. So we like the B and the C class properties. Those are our favorites. Now, we love C properties. I prefer C properties over B properties. And this is a simple economics thing, okay? So Econ 101 is supply and demand. So nobody builds C-class properties right now because the math just simply does not pencil out between the cost of land, the cost of construction, the cost of labor, building materials, et cetera, et cetera. So unless a developer is totally subsidized by the government, they're building A-class product. So from a supply perspective, you have a limited supply of these C-class properties because nobody's really building them. From a demand perspective, what we're seeing in our country right now is a shrinking of the middle class. So some people wind up going up into the upper class, but the bulk of those folks are pushed down into lower wages and lower income, right? And so what that means is that those folks, a lot of them are being priced out of home ownership. Some statistics just recently came out, this is September 2021, that median home prices went up 23% year over year. 23%, a quarter more expensive to buy a house. And so what's happening is a lot of people are being priced out of home ownership and they're becoming lifelong renters out of necessity. And so those folks are looking for affordable properties that they can rent. So you're seeing an increase in the demand for that type of housing and a decrease in the supply for that type of housing. So what we feel really comfortable about is that we're going to consistently have totally stabilized, fully occupied properties, and we will be able to push rents as high as the market will allow us to, simply because of the demand for those types of properties. We love Cs in Cs. Really important that you understand the economics and the strategy behind someone's investment philosophy before you give them your capital. So I hope that helps. So for more great content about real estate investing, about passively investing in opportunities like this, go ahead and hit the like button down below. You can also follow me on my social media channels. I'm on Facebook, I'm on Instagram @realestateadam7. Look forward to having you follow along.